I also would encourage you just to re-watch the PowerPoints. I know they're really lame and I'm hacking in there because I have a half voice. So I apologize about my voice quality and my coughing, but re-watching them, although it's kind of boring, is pretty valuable. Okay, so just consider doing that. All the PowerPoints or all the recordings are online right now, and I'll get this one online ASAP. So yesterday we talked about the deferral type of transactions where the money's there, we're just deferring the activity. Well, for accrual-based adjusting entries, we've done the work or we've had the expense happen. It's just that we've not gotten paid. There's no cash involved yet. So the waiting game here is cash. On the other kind, the waiting game is the activity. We've prepaid or we've gotten cash on the table and we've waited for the event to happen. Here, we've done the work, the expenses happen, but we're waiting for the cash to come in. When we're talking revenues, we've done the work, we've recorded the revenue, it's just that we're waiting for the cash. The work is coming before the cash. I think you're going to get that same little, yeah, here we go. So a service, when they haven't paid cash, no cash paid. Well, if we perform a service and we don't have cash, how are they paying? What other assets being increased? If cash isn't being increased, what's being increased? Like if I cut your hair and you're like, oh, send me a bill. Accounts receivable is being offset there. So if I don't adjust for that, it's going to look like we have less assets than we really do because AR didn't go up. And revenues will also be understated because it's going to look like we didn't do the work. If you don't list the adjusting entry, it's going to look like you have less assets, and it's going to look like you haven't done any work. Let's do a transaction. In October, Pioneer Advertising earned $200 for advertising services that had not been recorded. So what the transaction is going to look like is AR goes up and service revenue goes up. Remember, we're not waiting to record this. We are recording it when it happens. Then on November 10th, we actually get money for what happened the month prior. So then cash goes up and AR goes down. You might say, Mrs. Mars, this is not a new transaction. Like this is like what we've always done. Well, yeah. So that is the transaction set for when we perform work and we get paid later. So that's really not even new. I'm not even going to do a T account because it's something you've been used to. Overstated, understated. So had we not listed that we did work and hadn't gotten paid, it would look like we had less assets than we did, and it would look like we didn't do the work at all if we hadn't done that transaction. Yes. Not necessarily. Depends on where they fall on the big LOT. Yep. But in this scenario, if we didn't record this it would look like, you know, AR would have looked like it never happened, and the service revenue would have looked like it never happened if we didn't record that, okay? One of these again. Accrued expenses. So it means that the events happened. We're just not worried about the money yet. A big one there are salaries. Okay, your employees, okay, let's say we'll use December. Let's say your employees worked on New Year's Eve, okay? They don't get paid until, let's say, January 5th of 2018. We can't just write them off because they worked on New Year's Eve and say, meh. We still have to say that happened. This happened. This occurred. But we're not going to have cash show up until the actual payday. So salaries are a really good example there. If we don't do it this way, if we like, we're just going to wait till 2018, it's New Year's Eve, it's no big deal. No, you have to record it for the current year. And if we didn't do that, it would look like our expenses are understated, meaning the expense of paying our employees. And it would also look like liabilities are understated because we owe them. We owe our employees for working that day. It's just that there was a big stop because the fiscal year ended. So now I'm seeing two lower. So maybe that is the case. Let's look at this from a transaction perspective. Okay, this gets a little complicated. October is the end of the fiscal period. We last paid our employees on October 26th. We're not going to pay them again until October 9th. So it looks like they're getting paid every 2 weeks. Does it look like that? Yep. And there was a giant stopping point here because this was the end of the fiscal period. So we paid them on the 26th. We're not going to pay them again until November 9th, but there's a big chopping block in there because our fiscal period is ending and starting new. Remember, we're ending our fiscal period on October 9th. So yes, we know that they worked 1, 2, 3, 4, 5, 6. We know they worked 7 days in November. We're not worrying about that because we'll worry about that next fiscal period. We have to account for, they got paid on the 26th. They worked 29, 30, 31. They worked 3 days since they last got paid in our current fiscal period that we have to account for. The employees received total salaries of $2,000 for a 5-day work week. In other words, $400 per day. So when they work a full week, they get $2 grand. Are they working a full week in this fiscal period since they got paid? No, because we're stopping it on October 31st. They figured it out that that's $400 a day, and they worked 1, 2, 3 days until stop. We have to close our books. So $400 times the 3 days, we owe them $1,200 worth of payment. Riley, did you have a question? Okay. So what does this look like? We have a salaries and wages expense of $1,200 because we owe them a payable of $1,200. Salaries and wages expense is income statement. Salaries and wages payable is balance sheet. Where did we come up with the 1,200? Well, they make $2,000 in 5 days. Figuring that out to be $400 a day. And they only worked 1, 2, 3 since they got paid. And then we got to stop and say fiscal year end. We owe our employees for that, but we're going to expense out what happened even though we haven't paid them. That's the whole nature of an accrued entry. We got to say what happened even though we don't pay them. We flip the calendar to November. We start a new fiscal year. Smooth sailing, but we still have to say we have employees that work 3 days. It happened, and now we owe them. Let's talk about another thing that happened, even though there's not cash involved. The asset equipment will not retain its value. Your cars do not retain their value. You drive them, you bang into each other, you hit poles, you drive on gravel roads. Your vehicle, we live in Minnesota, there's ice, there's salt on the roads. Our vehicles depreciate really quickly in the area that we live. And kind of like supplies, we use them. Okay, supplies decreases in value because we use the supplies. Our equipment decreases in value because we use them. And as we use them up, we have to depreciate. We're going to spend a whole chapter on depreciation. There's different methods. There's straight line, there's double declining, there's units of activity. We'll spend a whole chapter talking about it. You get just a little taste right here. For Pioneer advertising, assume the depreciation or how it goes down in value on equipment is $480 a year. Assume that that's how much is going to go down in value in a year. So if we divide that by the 12 months, it's $40 a month that it's going to go down in value. So we have depreciation expense for the month of October at $40. Remember just how remember how before we had a supplies expense. We had a salaries and wages expense. The expense of happening or the expense of using it. Now I'm going to throw a tricky one at you. Do you think equipment's going to be our credit? I wish I could say yes, but it's not. Accumulated depreciation is called a contra asset account. I really wish the chapter didn't throw this at you yet because it's taught way better in the depreciation chapter, but I'm not the textbook writer. You will not see equipment credited, rather you're going to see accumulated depreciation credited. I put that in your notes, not equipment. The way I teach this, and I'm going to draw a little car here. Here's my car, okay? Your car drives along, and as every month goes by or every year goes by, a little chunk of it is gone. And that little chunk that went right here gets put into an accumulated depreciation pile. Okay? And another month goes by. Another chunk of your car physically is gone and put into that accumulated depreciation pile. That accumulated depreciation pile is considered a contra asset because it offsets the value of your car. Good question. No. In that month, it would still be accumulated depreciation 40. So this would be October. It would look the same in November. It would look the same in December. But in the depreciation chapter, you're going to see this pile growing somewhere else. Because if we go post this right now, the accumulated depreciation from October would be that. November it would be that. So you'd see the pile growing in the general ledger. Okay, when it's now, and this is getting a little bit advanced, but keep in mind an asset has a debit balance. This has a credit balance, so it offsets the value of the equipment. Your equipment technically is still, you know, like a combine, big dollar amount, 500,000. Okay, it's got a contra asset account called the accumulated depreciation dash combine that grows, but it's a credit-based account, so it offsets the combine or the asset account. Really good question though. Would the next month be 80? No. Every month, month by month, it would look like this. You'll see the growth happen in the ledger. You'd see your combine at 500,000, and you'd see that contra asset growing a little bit to kind of offset it. That's a tricky one. Because, whoa, where did this come from? You'd think it would be equipment, and it's not. It's just how depreciation works. Oh boy, here's another one. Pioneer Advertising signed a 3-month note payable in the amount of $5,000 on October 1st. The note requires to pay interest at an annual rate of 12%. Again, this is previewing another chapter. But here we are. We have to account for how much interest happened in the month of October. Remember, in 3 months, we have to pay our $5,000 plus interest back to the bank. But we have to say how much interest happened this month. We got to say how much interest happened the next month. Well, you'll learn that principal times rate times time gets you your interest. Well, we have a $5,000 note at 12% interest. We've only used up one of our 12 months, October. So how much interest has happened in the course of October? $50. So after October, I owe my $5,000 plus $50, and then I'm going to owe another $50, and then another $50 for this note to expire at $5,150. Have we paid our note back yet? No, we're not going to pay that back until all of October, all of November. We're going to pay it back on December 1st. But has there been an event that's happened? Yes. $50 has climbed up on what I owe. So if I record the journal entry, interest expense, $50. It wasn't money in, it wasn't interest revenue. Now I don't want to complicate things, but if I would have given this note to someone else, it would be interest revenue. I forget if they do it that way. They might. I don't think they do. What do you think the credit's going to be? I know that this is an income statement account. What balance sheet account do you think the credit's going to be? My question for you is this: do we owe $50 to the bank now? When you owe someone, it's a payable. If it was interest expense, what do you think it is? Interest payable. Very good. Kind of like Jenna asked before. In November, what would this look like? Exactly the same. But is the interest kind of like accumulated depreciation piling up? Yes. But month after month, it's looking just like this. I know I'm not making T accounts, but I don't think we really need them this time. Is this in your notes that I gave you? This is an awesome table. Because it says the type of adjusting entry, had we not adjusted, so if we didn't, oh my gosh, I'm going to start over. If we didn't adjust, what would happen? And here's what the entry looks like. It's an awesome memorization tool. It's an awesome one when you're doing the problems. The top ones are deferrals. The bottom ones are accruals. With deferrals there, the money is there. The event has not happened. On the bottom, the event has happened. The money isn't there yet. It's an awesome snapshot of everything that I've explained to you in the last 2 days. Just remember the rules over here. You need to have a debit and credit. You need to have something from the income statement and balance sheet. Let's write them. Expenses is income statement. Assets or contra assets are balance sheet. Liabilities are balance sheet. Revenues are income statement. Assets are balance sheet. Revenues are income statement. Expenses are income statement. Liabilities are balance sheet. Jenna's question from before, you know, like the top ones seem to be, if one's overstated, the other one's understated. Jenna, I think this is your answer. These are all understated. If you don't do them, they're all going to be understated. Holy moly. It's a lot of talking about it. Do you think it's going to help if we just do it? Yes. This will be asked of you on the test in like question format, like multiple choice or true false. I have this slide on there again. I feel like we've talked about this enough. It leads into our last section of the chapter. As we look at 5 to 10, we have about 15 minutes left. Would you guys like to start and end a chapter just of all the journal entries before we move into this? I don't think we'll finish them all today, but that means we'll just pick up where we left off tomorrow. Sound okay? All right, I have to just remember which problem we're going to do. Good job. I know it's tricky. It looks like we're going to do exercise 3.5. I would assume it's in your workbook. You'd want to find it in your textbook. Should be exercise. So it should be page 138, exercise 3.5, Vernikova Company. You guys see it? Okay. Do you have it in your workbook? Is it just one big general journal? Yes, and everything's dated. Okay. One thing we can't do right now, where the debit and credit columns are, can we put pluses and minuses there? Because it depends on which side of the big T you're on. But just remember, if you have a debit, you have to have a credit. If it's a balance sheet account, the other one has to be an income statement account. Okay? Vernikova Company has the following balances in selected accounts on December 31st. So going into the end of the year, their trial balance shows this. And it's not even a trial balance because it's not in order. Looks like no one owes us money. Accumulated depreciation pile is nothing. Looks like we own $7,000 worth of equipment. So do you see where, like, going in, those are your balances. All the accounts have normal balances. The information below has been gathered on December 31st. Okay. So what they're wanting to do, there's 7 transactions, and we have to do those adjusting entries. We have to update those accounts because time has happened. And now it's time to close our books and get everything up to date. So we're doing this as the year is ending on December 31st. Cool? It's not month, it's year. Vernikova Company borrowed 10 grand, signing a 12% 1-year note. And when did we go to the bank and say, I need $10,000? On September 1st. So my question is, how many months have gone by that we've had this note? All of September, all of October, all of November, and all of December. 4 of 12 months. Now, before we even do the transaction, let's figure it out. We borrowed how much money? $10,000 because it's principal times rate times time. What's our interest rate? 0.12 times how many months have we used the note? 4. Because what we're trying to figure out, we have not paid the bank back. We don't owe them until next September. But we have to account for how much interest has piled up. What's our expense of having interest pile up? Interest expense and interest payable. My stuff's covering up. We've got interest expense debit, interest payable credit. So because we signed up for a $10,000 note on September 1st, 4 months have gone by at 12%. We owe $400 as a result of time going by. Are we paying that yet? No. So we're going to label 2 things. We're going to label ISBS, and we're also going to say, is this an accrual or a deferral, just to keep our vocabulary up to speed. Interest expense, which one is it? IS or BS? You guys might think this is all BS. Isn't that a funny joke? Okay. IS, thank you. And any payable is coming from the balance sheet. I want to label those. Now, is this an accrual or a deferral? It's actually an accrual. The stuff has happened, we haven't paid yet. How are you feeling after one transaction? So-so. Let's keep going. Account of supplies on December 31st indicates that supplies are $900 on hand. Is it safe to say we use some? The question is how much? What did we Like, what was our supplies balance? Look up in that top part. 2,400. 2,450 minus what the minion counted, that's still here. How much was that? 900. We used 1,550. I hope. Yep, I did my math right. Okay. Do we still have all those supplies? No. Supplies is going to be credited. What's going to be debited because we used them? Supplies expense. Very good, and it shows the math. Well, wait a minute. I thought we had 2,450. The minion said we have 900 left. Why would we not put 900 out there? Why would we not debit and credit for 900 bucks? Because that's what's still here. It's not what we used. This is what we used. All right, let's ISBS this. Any expense belongs to the income statement. Supplies are an asset that's part of the balance sheet. Was it money involved right away, or did the event happen? It was money. So this is a deferral. We deferred the use of our supplies over the course of the year, but money was at the front end of the transaction. Number 3. Depreciation on our equipment. Let's think about this a minute. We own equipment and it's not going to retain its value. They're saying depreciation for 2014 was $1,000 bucks. Do we have to even figure out any math there? No, because we're doing this for all of 2014. So your number is going to be 1,000. What are we going to debit? It's an expense. It's the depreciation expense. Are we going to credit equipment? No. We are going to credit a contra asset called accumulated depreciation on the equipment. They gave us the $1,000. They told us that. Any expenses in income statement. The other one has to be balance sheet. More specifically, it's a contra asset that offsets the value of our asset. This is an accrual because we had our equipment. We bought it. It's just that we haven't actually like sold the thing and gotten cash for it. So the accumulated depreciation happened. It's just that we haven't had money involved yet. Number 4. Vernakova Company paid $2,100 for 12 months of insurance coverage that started on June 1st. Okay. I can already tell it's going to be a deferral because we paid for insurance coverage. Okay. We're going to see an asset go down because we don't own as much of the insurance anymore. And we're going to see an expense occur as a result. Let's plug the first bit in. Insurance expense and prepaid insurance. Now, how did we get to $1,225 of insurance gone? Well, we bought $2,100 worth. We have used 7 months of it. It looks like we bought a 12-month policy, so it's going to cover us from June 1st of this year to June 1st of next year, but the books stop, the fiscal year ends, and we have to say how much of our insurance did we use up. Well, if it was on June 1st, we got it all of June, all of July, September, October, November, December. Why am I only seeing 6? All of June, all of July, all of, did I miss a month? I must have. Okay, thank you. We got it June, July, August, September, October, November, December. We use our 12-month policy 7 months. So we can't say all 12 months went by because only 7 months went by. Let's do one more. On December 1st, we collected $30,000 for consulting services to be performed from December 1st through March 31st of the next year. Holy moly. So there, you know what I forgot? An expenses income statement. Prepaid insurance is an asset that belongs on the balance sheet. It's all prepaid, meaning it's a deferral, meaning we've got the money, we're just going to defer use of the asset for the next, in this case, 12 months. That actually is a good stopping point. We'll stop there. Yay. We'll go through the rest of this. Now here's a, would you like this tomorrow? Instead of me jumping into the next section, would you like me to finish this and then do maybe 1 or 2 on your own of just this before we go into the next section? Okay, maybe what would be good is if I would go through another one with you and then you do a 3rd one on your own. Okay. Now you guys, the test is a week from today, so we've got a whole nother section left to finish, plus A, B, maybe a C set, and a practice test. But we can do it. I want to slow down though. This is hard.